we are looking at the markets after one of the strongest and hardest falls in about 5 years. That gets most people talking and wondering how much further can it fall. But we've seen this many times before, not necessarily this fall, but rhymes of it. And Gary Glover's the one who goes through the research, trawls out the numbers, and understands when it has happened before, what does it look like and what can we expect from it. It also fits into the blueprint that he's created at the start of the year. Then he also looks at the trading shares, things that he'll be looking at with great amount of interest to see which ones will recover the best, to add to the portfolio, and what to expect from them. A lot to fall on his shoulders, but these are the markets that Gary Glover waits for. Good morning, Gary. How are you?
I'm good, Chris. Good. Yeah, obviously pretty exciting couple of days. Yeah, I actually didn't sleep well on the weekend. Just not because I it's depressed or anything. It's because I was just thinking about, these are the sort of these opportunities don't come. You don't see these big panics very often in the marketplace, so you're gonna take advantage of those when they do come. You got cash there on the sidelines, so you've got it. I still found it amazing yesterday. A lot of trepidation, in the market there. So, I think sometimes you got to sort of look through all the noise and all the smoke there. And, I thought the one thing I sort of was asking a few clients, because obviously we've gone from 86 down to 7,200. That's a fairly big, pullback there. I'm sort of saying to clients, do you reckon we can bounce back to 8,000, in the next month or 3 months? And pretty much everyone's most likely. So, you color, if you think that way, then you actually got to act with that in accordance as well. So, I don't know. I've seen these panics before, Chris. I know sort of. I wasn't expecting us. I thought the March low was a low, so I was definitely wrong about that. But I thought this April would be a higher low rather than a margin yellow, rather than a deeper low. So, but the post-election years, lots of early April lows, and the fifth years we get lots of sort of mid-March or late March lows there. So those cycles there, the two cycles there, still in alignment there. We had our sort of mid-March dip, and we've had our early March dip as well, obviously just a little bit further here. So I still think it's pretty interesting. The thing that I found amazing, Chris, when I was looking at the weekend, I was looking up tariffs there, just trying to get my head around it, but found it quite amazing. We've often talked about the 60-year cycle here, how markets mirror that 60-year cycle. And we've had a lot of, probably 8 out of 10 years really follow, and some years they follow it really closely, even to the point where the high of the month and the low of the months are the same. I've seen it going back to 2007 and 9 there, where we had the commodities sort of boom and bust there. We had metals finding the highs, to the date, 60 years, sort of anniversary dates of highs in similar cycles. I don't know why these things happen, but I just know. I know Gandalf referred to the 60-year cycle as a master cycle. It's just one of those cycles that sort of keeps presenting itself, and we keep following over and over again. But I was reading about tariffs. I was reading about President Johnson introduced a tariff in May 1965 on light trucks, so any pickup trucks, just sort of any small trucks there, which I think half of America owned a pickup truck. So that caused a panic in the market, and that panic actually lasted 45 calendar days. I think it went from 13th of February 1965 into 29th so it went from May to June. So that was 13th of May to the 29th of June. So 45 calendar days it left. And we see those 30, 45, 60, 90-day corrections quite often, that they're the sort of timings I look for all the time. We just see them over and over again. But the fact that 60 years ago we had a panic sell-off for 45 calendar days, and I was reading that basically on the weekend. I thought, okay, well, I looked at the calendar, all the cycles. The S&P was going to be 45 days on Monday, 60 years later on a similar type of, maybe not the same scale there, but a tariff. So, it's just eerie how those sort of things, So I don't know, it gave me confidence there. The thing I found amazing about that 60-year cycle, Chris, was not so much that we had a 45-day sell-off around 10 or 12% on the back of those tariffs. Was what I found most amazing was within 3 months, that market in 1965 had gone back to, by September 65, market was at a new high. So I thought, wow, geez, that's bloody bounced back pretty quick. So I don't think that also
Got power.
yeah. So it gave me confidence we can bounce back pretty strong here. I don't think we're going to bounce back that strong, but I'm pretty sure we can bounce back at least half of this range here within the next few months. So, and the one thing you notice about, if you study sort of really deep market corrections, these sort of panic fast sell-offs, you'll see that we go back to the midpoint of the drop in pretty quick time. Sometimes it can be within 3 or 4 weeks of that low. So I've sort of studied some of the biggest declines in history. They can bounce back to the midpoint pretty quickly. You then sort of come back and make a higher low, or some sort of, not retest, but a deep retest and maybe a higher low later on. And then you build maybe more slower after that. So there definitely is a building process, but you can get a pretty quick bounce in short term back up to around that midpoint. There's a 45, 50% of the range there. And I reckon about 90% of the cases there. So that's a pretty interesting. But digress, probably look at these charts here. I didn't have a look at the ranges there. I was sort of a bit too busy trading the market yesterday. But I noticed that we've come back. A lot of those markets have come back to, like the Dow and the S&P expanded like 100% of that range. They've actually come back and filled that whole range. So they've come back to the, So that's amazing. So we expanded 100%. We've come back 50% of that range or 100% of that previous range there. So yeah, that's a killer level as well to bounce from too. So the one thing I've learned from this is that we talked about when a range expands 100% or 200%, that those sort of key expansion points, the market stays under that level for at least 6 months, sometimes longer. If I see that again, I would tend to, having gone back in history now, I'd have to trade that a lot stronger on the short side, because I thought it was just going to be more of a pullback, but not I thought it might do a bit of work here and then lag back, and so I think I had a small short on, but nothing substantial there. In history there, I wish I could have traded that a bit harder, but we live and learn here. But I do feel like we've had a pretty nasty pullback there. I've definitely seen fear really elevate here on fear of the unknown, Chris, rather than what is known, I think, as well. Everyone's kind of guessing as to what is going to happen here. And the reality is a recession coming? Is it going to cause issues? No one really knows. It's just the fear of we're not knowing. And we won't find out for probably 3 or 6 months as to whether this is going to cause any long-term damage or not. So may cause very little, might cause a lot. No one really knows. So, but markets kind of, got quite fearful here on the not knowing part of it. So, yeah.
Well, we definitely don't know, but we do know that we need to trade the market in front of us. And I think what you've described there really covers most of what we can expect to understand from these charts. You're talking about the retracements, you're talking about them being significant levels. Is there anything more to add to them, or that's kind of we're in such...
Yeah, well, I think that one has, I sort of looked, the key level I saw was at 50% of the range level. So I thought, wow, that's going to be, that's a big pullback for an index to come back 50%, that range. That's a, 2.25 years sort of move here, almost a 2.5 year bull market, and then come back 50% within 45 calendar days. That's a pretty sharp whacking. So, so when sometimes you might see them come back to 61.8, but I just look, considering the panic here, felt like that was a good level there. We'd probably see some sort of bounce. I think it might have just slightly surpassed that level, but yeah, it's a level where I think we might see some support here. So, I'm just I think that one has always been a bit harder to read than NASDAQ, just because it's whereas I think the Dow and the S&P haven't expanded 100 of those ranges. That sort of, that's hit those levels bang on here. Now we've come back and retested that old level as well. That's a big, we know when we sort of, in a normal trend, if we're building on top of, after you break through an old high, sometimes you'll come back and retest the low. I mean, I think the Nikkei was one of the first indices to break out in 23 or something like that. It broke out to a new high. I think it rallied for like 4 or 6 weeks on that. Then it came back about 10 weeks and retested the breakout zone, and then it went again. So we often see this on shorter term scale here, but we're seeing it on the bigger scale here, come back and retest those old highs here. So, our market's definitely overshot. But if you study our market history, we've got a history of some really deep panic lows there. If you go back and look at monthly charts there, you'll see there's really long tails. Like every few years, you'll see there's really deep lows there. All right. And one of the reasons that is, Chris, is that because we are open when most of the other markets are closed. So it causes a lot more duress on our market there because we're there in that trading zone, we're often the only market open. So that can cause pretty big swings when there's stuff going on in the market and you're the only market open.
So yeah, if you want to hedge internationally, was it 4 nights a week, 5 nights a week? It's the place to hedge if you have that window where you need to do it. And obviously with the announcements after market close, well, it does have impact.
Because I was even looking at levels there yesterday. I was just thinking, I just look at that panic there. I mean, oftentimes when you see, like in the past, we've seen like 800 or 1100 point declines in the Dow. They're normally been those big sell-offs where you normally capitulate in the lows there. But we saw 2100 the other night. Oh wow, that's big. I can't remember seeing something like that big. Not in my lifetime anyway. So I know that numbers get bigger and bigger as the index goes higher there, but percentage-wise, that's a pretty decent percentage-wise move. So that sort of capitulation. And I was thinking over the weekend that, by the time Monday morning rolls in, the futures will be up 2%, the panic will have subsided and, we'll be buying at a higher level. But the reality was that the futures were off 5 or 6% in the morning. It was like, and the panic was set in hard as well. And so, to me personally, those opportunities, I get excited. My blood starts to get warmer and fuzzy, and I get excited with that sort of stuff. It's sort of sometimes the market's just grinding away. It's just the same thing all the time. So I know it's not good having these big pullbacks there, but they are sort of opportunities as well. You've got to do, I think you got to do something in those times there. You just don't see those panics very often.
Well, market definitely has panicked. It has rebounded significantly. But if we progress beyond the indices and then look at some of the opportunities that you were looking at, I was going to say companies, but we know Hearts and Mind, it's become a listed investment company with a different type of structure and focus. Why was it Hearts and Mind? Why a listed investment company? What brought this to the top of the list in the report?
Yeah, look, I was looking at a few, like I bought some gear, which is the geared ETF on the ASX 200. So what that means is if you think the market can bounce, say 10%, the geared GAR is a geared ETF there. That'll give you like 2 to 2.5 times leverage there. So the rally's 10% here. This will make, say, between 20 and 25% on that instrument. So get a bit more gear in there. It's not for the faint-hearted. You got to be. It's more for the aggressive type of sort of trader here. But that does give you, if you do think you're going to get a reasonable bounce here, that does give you a bit of leverage there. But for most sort of my clients, they're sort of portfolio orientated there. I was looking for I don't like ETFs, so I won't go on why I don't. But I like the LICs because they're a closed fund. They have to report their NTA quite regularly, and it's very open. You can see what they're holding. So it's a lot more opaque than any ETF you'll see. But being closed there means there's a valuation there that you can sort of trust a lot more. But I noticed that this one started to come up, and this Hearts and Mind is like a 25 to 30 high conviction picks by like a lot of different fund managers there, and they donate their fees to charity as well. So it's nice in that regard. But I noticed this is a bit more responsive than some of the other LICs because they've sort of probably got a broader, universe there. And they and sometimes I find that LICs, because they're pretty broad, they tend to sort of move a lot slower as well. So they're sort of a bit more of a lag, So I just knew that this one would be a bit more responsive there because I knew that they trimmed a little bit of CBA near the highs there, and they were adding a little, some more resources in. So I just knew it was going to sort of be a bit more responsive there. But I think the NTA was around about 304 from last week, Chris, and it got down to 250 yesterday. So I know it would have been a bit more lower. So it might have been 290 after maybe coming off a bit lower there. But I thought, there's some value there, and the fear is in there. So, yeah, good yield there. Yeah, so I bought some of that for a few clients there around the 250. Well, I think it was open now. I think it traded around there for a while. So, yeah, I just think you'll get a nice move. And to be honest, it'd be big one you can just probably hang and hold in the portfolio pretty well. They predominantly sort of hold some of the bigger cap, sort of stronger names there as well. So I think they're typically the first stocks to move as well. If you think about, what you should be buying in the market there, normally you sort of see those big caps move first, then mid caps, then smalls later. So the money will flow to quality first. So it just made sense to me.
Well, another one that's in the list is Netwealth, not LIC manager, but you can definitely buy LICs through Netwealth because that platform, a lot like Hub24.
Yeah.
Why there is it?
Well, in the old days, I used to buy like ASX because that used to be probably one of the closest market proxies. But then obviously in the last 5-10 years, it's had a few issues and it hasn't necessarily followed the market like it used to. Whereas Netwealth is really sort of the platform that a lot of brokers, so Netwealth and Hub are the two big platforms that market users sort of use there. So this is based on the funds going in there and the funds under management. So if the market, again, it's a bit of a market proxy as well, because if the market, I found that if the market goes up, say 10%, Netwealth will go up 20% in the stock price. But if the market pulls back 10%, Netwealth's probably going to pull back 20%. So it's a high delta type of stock, very market orientated. So, but in longer term, money's going to keep flowing into super funds. These sort of Netwealth platforms and hub platforms, they probably should keep growing in size there. It's just that with the market correction, funds under management will take a bit of a hit. But if you think the market go back up again, then they'll move there. So these are sort of, high octane, sort of high delta stocks. So it just sounds weird. I know a lot of people think, when things get nasty like this, you should go defensive, but they're not the things that come out of here that move the most. People go to the high quality sort of growth names pretty quickly back in there after they've taken a hit there. So yeah, I sort of tiered some buys there on that. So I was lucky enough to get hit on both of those levels there yesterday. So yeah, worked out all right there, I think. Yeah. So it's a stock I think I'm pretty happy to own longer term as well, Chris. So I think that's the key there when the market's sort of having those sort of meltdown moments there and fear and panic in there. Try and buy the names that you'd be happy to sit with, like, 3 months later, you'd like to be holding those names when the market's all calmed down and settled and, and kind of normalized. So buy the names that you'd really like to own and, maybe the names that you missed in the last bull run, so, so Netwealth is probably one of those ones for me where I sort of looked at buying this. It always looked too expensive, but as you can see, they continue to trade up the whole bullish phase there pretty aggressively.
Well, another one where you're talking about high beta, high delta, large, massive movements, and often an extension of if the market's up 2%, this one's normally more than that, or quite often, is Macquarie. But the whole exposure to the US being a multinational and having fewer of their revenues actually being in Aussie dollars, you might think that as the dollar's coming under 60 cents, that could be beneficial, but it got thrown out by hard yesterday. What's your take on Macquarie?
Yeah, again, I was sort of looking because obviously the banks have actually, the big four banks have actually held up pretty well. So while the market was sort of in turmoil there, we saw actually some of the, CBA actually traded up last week. And then obviously you saw Woolworths and Coles, Metcash, some of the staples, so there was a bit of a defensive move. Even things like Sonic traded pretty well as well. So you already sort of saw some movement towards safety there last week. But I thought, wow, okay, Macquarie comes off pretty deep here, but it is sort of viewed as a high growth, high beta. The market is going to find a low here. This could get sold off a bit bigger. And if it does sort of settle here, I think it'll bounce back here. So I look at that sort of trend line around the 165. So I was hoping it might get hit around there. But also that, if you think about wave 4, when the market runs up and it has a long correction and goes into a fifth wave, it'll often come back to that wave 4 zone, which is around that 160 zone there. So where that October 22 low was. So what, the one before that, Chris, that was sort of that's probably the deepest low there. So I thought, wow, if you got anywhere near that, I personally, I'd have to try and buy that. So yeah, so lucky for me, it actually opened at 160.88. So I was happy to buy at 165 personally, but Yeah, so I think this one will bounce back pretty quickly. I'll be surprised if it doesn't go back to 200 within the next 3 months here.
Now, you've talked about the next one quite a fair bit. We've had a lot of the insurers use this company for the repair work, and the natural disasters do ramp up the business. We've talked about a few different changes within the company that should be positive. We've put it in the context of what's been happening. What's your stance on John Lyng now?
Yeah, I just the chart's sort of come off there. It's had a couple of misses. So it tended to gap down pretty aggressively after sort of even having a fair result, but just not as good as the market had anticipated. So I've been sort of buried a couple of times there. I thought, okay, I presume there must have been a debt issue there, Chris, because I thought the valuation looks pretty low. And I was looking at a few other stocks recently, just sort of trying to work out which stocks might bounce back out of this market low and where was maybe some good valuation, sort of possibilities there. And yeah, when I was looking at John Lyng, I thought, wow, this is it. Market cap was around 600 mil and it was doing 1.15 billion in revenue. I thought, okay, wow, that's something like a lot of companies trade at least 1 times revenue. Sometimes, some of them trade 8 to 10 times revenue. But even the companies that are beaten up probably trade in that sort of 1 to 1.2 times at least, unless there's a debt issue from what I've normally sort of found here. So it's only got 100 million debt. So I thought, oh, okay, what's the market scared about here? Because normally when you see something like that, there's normally like a debt issue in there. But yeah, I just couldn't see the debt issue. So yeah, I just thought it looked pretty interesting here. So I thought it definitely I thought it definitely sort of could come back here. So they got a bit of a descending wedge there, which is like like an ending diagonal pattern. So that was like a bull market. You've been running up, and then you had that ascending sort of wedge there, like an ending diagonal. That'd be like a bearish technical setup there. You're seeing the volume start to decline as well. So you can see volumes have declined into this low. So got a bit of a descending wedge here, declining volume there, sort of selling drop here. So I think this looks pretty interesting. I just think from a valuation perspective, it's actually got a bit of room here. So I'm guessing the fear, Chris, is that a lot of Australian businesses haven't been that successful trying to roll out into the US, other markets there. Yeah, and that's probably the reason there. So
Harvey Norman, Red Leaf.
yeah. So that's really that's obviously the reason I think that they're concerned there. So that's probably sort of something to monitor. But yeah, it's trading at half its revenue. Gee, it's and it's still making a profit. It's not losing money. Still on the profitable side there. So it's not even a company there that's actually losing money as well. So yeah, so I think this gets a few things right here. The share price could really appreciate. So yeah, I mean, just go back to 1 times revenue, be about $4. So yeah, and it's a US. If they can sort of get a little bit of traction in the US and have and the other thing too, we've just gone through a pretty nasty wet season here in Australia and sort of Queensland and Sydney. So the work's going to roll out for them domestically. So they're probably going to have a pretty good year. Sort of 25, 26 on that basis. So yeah, but yeah, the share price is under the pump here. But yeah, that's more of a fundamental call. But I look, the chart's interesting here as well because we definitely got our little ending diagonal sort of set up here. So yeah.
Well, the next one on the space is Fletcher Building, a chart that we've talked about a fair few times on and off air, being pretty happy with the compression that it's building. This is a weekly chart, and the daily chart's even more compelling. You've got 0, 1, 2, 3. Other conversations of ours have said how rare this has been, this kind of pattern in the last couple of months. So what are you looking at for Fletcher now?
Yeah, it's just been holding up pretty well, Chris. Sort of considering how weak the market is, it's done pretty well. It's definitely sort of broken out of that little sort of descending sort of wedge sort of channel there. At the low, so we had a bit of a breakout of that, but we might just come back and retest that zone here. But yeah, again, we've sort of got 0, 1, 2 here. We might sort of set up our third high low here if we can hold here next week here. So I think it's gone slightly lower here. It hasn't come back that much here yet. So held up pretty well. It's some interesting stuff happening in New Zealand there. Sort of, you're reading about the government sort of offering green cards for anyone coming into New Zealand who's bringing in money and a business. So if you want to set up a business in New Zealand, they'll give you a access there. So the government's trying to get, obviously the government's had obviously the New Zealand's been in a bit of a recession there, definitely going through some pretty tough times. Obviously it had immigration outages and just economy is pretty weak overall, but the government's trying to do this, it's trying to implement a few measures there to get things sort of stimulated there. So we've seen interest rates come off, been cut quite dramatically there. So that's given retailers a boost in New Zealand. So starting to see some positivity there, but government sort of taking some actions there, trying to encourage business in there is good. When I sort of read about things like that, I thought, okay, that's it. Government's trying to do what it can to try and recover here. So, the previous New Zealand government was a little bit not that way inclined. So it's interesting to sort of see a government trying to bring in policies there to try and stimulate business activity in the country. So that's positive longer term for New Zealand.
Well, a different one is EBO, Ebos Group. So the healthcare animal care company you have spoken about before. We do see this 0, 1, 2, 3. It's not that it's common. It's just that you go digging around for them and then put them in the report. So
Right.
Ebos, different sort of structure. How do you see that one playing out now?
Better watch this one, Chris, because this is sort of contender to be 52-week high, a couple of weeks after the market low potentially. It's been pretty strong here. I mean, look at it. Well, the rest of the market's been melting off here pretty hard. It's actually it's formed a series of high lows here, so it's been very robust there. It hasn't shown too much weakness at all. So I've been trying to pick this stock up for a little while, but hasn't really had much weakness there. So I thought it might have just congested back. But yes, so far I've been sort of struggling to buy this on any weakness there. It just hasn't shown much weakness. So, one stock I'm watching closely there, just because it is showing that relative strength that we know that the next leadership generally does have. So the stocks that hold up the best there when the market's in turmoil, are the stocks that sort of, we know sort of typically do well sort of coming out of these periods there. So yeah, definitely pretty interesting company to be watching here.
Well, what I like in the next chart is the weekly chart looks very, very different to the daily chart. So the daily I've just looked at before scrolling through, it's just terrible. So looking back over the last 12 months, you imagine that's just downward traffic and just gets faster and faster and faster. And then obviously the volume is quite high too. But your chart here, the weekly, as you've dug up and put into this week's report, tells us that we've been in this territory before and tells us the story of how we got to be so high. So you've got the red marker here, which was sort of the target that you're after around the $13 mark. But the context of those who are watching, well, the updated report, it got down into the lows where it was at sort of 13.38. I'm looking at yesterday's pricing. They got right down into that level.
Yeah, got near. I was actually sitting under there. Let me break that level. Because I've seen this sort of set up in the past, Chris, where A2 milk was actually the last one there back in October 23, where I think it went from like $4 to like $7 and then came back, retested the low, broke the low. Did shake me out, unfortunately. But it did mark that marginal new low, and then it actually went back and made a marginal new high again. So we can see here that with REH there, we've basically gone to a marginal new high, and then we've gone really close to, when you see them sort of coming off there, it's weird. You see the sort of setup, think, geez, makes a marginal new high. That potentially could come back and make a marginal new low. That's a big move. I mean, 29 down to 13. It often seems incomprehensible there. And I remember the S&P 500 might have been, I'm not sure when that was, up over 9709 there, when it did a marginal new high as well. I thought, wow, that's like a 50% correction in the S&P. Oh, that's not going to happen. And unfortunately it did, but it did come back down and retest the lows. So I mean, sometimes you see those broadening patterns where you sort of margin new high, they can come back there. So yeah, I thought it might come back, but look, it did sort of bounce just shy, and that does happen sometimes. Sometimes it gets close and not quite there, but I will watch this one here because it's still not over yet. So but yeah, oftentimes that's when you see that broadening pattern, they can come back and retest those high, like those previous lows there. And oftentimes that marginally low there, if you do get a false break, that lower recovery, it's often a great place to buy them. So, if it does happen here, then I'll make sure my stop's a little bit wider than I had on my A2 mils.
Well, there's definitely a short list to look at. We're doing the last recording until the other side of Easter, so we'll take a little bit of a break, and no doubt there's going to be a lot of volatility in between now and then. And you've talked about at the start, taking the benefits of learning from history and digesting that to then apply to your own trading and how you run your portfolios. But no doubt over that time, people are going to be concerned about, well, what can happen, what does happen. So what are the things that you'll be looking for up until the Easter break that in the portfolio? Would you be looking for another hit, or you did a fair bit of buying, you said you were busy yesterday. How are you going to manage the next period until Easter?
Yeah, look, to be honest with you, Chris, I normally sort of, if I get a little bit of a pop and go, I often sort of do trade some into heat and take some off, but I felt like I've bought the right stock here this time, and I feel like I should try and hang on to it a bit longer here. So I feel like this is a good deep low personally. I know there's still a bit of noise out there, still a bit to be decided there, and I'm sure that we news articles about this and that and possibilities of recession, but I think it's kind of noisy, and I just feel like the panic kind of hit a high echelon there yesterday of the weekend. Kind of like the panic was at an extreme there, so I'm just not sure we're going to see panic as great as that. And it's not sort of trying to judge whether it's a low or not. I think you got to judge the level of anxiety and panic in the market sometimes, rather than as far as I wasn't looking at levels. I was more worried about, I was more getting a feel for how panicked everyone seemed to be. And even sort of, even yesterday, I think only one, listening to Ozbez, I think only one other broker there, he's been around for a while. And he sort of said, but maybe you just invest, if you got X amount of dollars there, maybe you put half in the market and hold half back. But I think he was the only other one that I heard that was just suggesting you should do some buying in it, which it kind of, I don't really understand. With the market's off 15%, isn't that the time when you should be buying? So when it's panicking. So I don't know. Good to be putting something in there when the market's under a lot of pressure like that. So I don't know. I've been a broker for a long time here, so I know sort of in the past there where you come out at sort of dealing rooms and everyone's panicking. Yeah, that's usually the day to really sort of start buying. So that kind of felt like yesterday. It was sort of everyone was pretty panicked. If we start to see that panic start to decline, it already feels a bit less panic today. But if that panic sort of continues to sort of ease off there, I think you'll just see the market kind of climb here. So look, I'm optimistic. I still think we'll see a recovery there. And just, it's hard. We've had a pretty big pullback, Chris. That's probably the only thing. It kind of, maybe that doesn't, puts a, maybe a lid on this year. So maybe that, maybe we're not going to hit the heights that we hoped for by the end of the year, but still think we'll see, much higher levels here. I think we'll see a bit of recovery there, but maybe we're not going to go as high as I expect. But it's bizarre if you think about the start of the year, all the Wall Street came out and gave their targets for the year, which is about 10% higher, and so that was probably a bad sign as well. But in the last week here, or the weekend, we've had everyone on Wall Street come out and downgrade 10% lower here. So that's a good sign.
20% range in 3 months.
It is. So now you dropped 10 or 15%. Everyone's lowered their expectations to 10% lower. And when the market was roaring, they were 10% higher. So it's actually a good omen that everyone's quite negative here. So they got negative quotation. So so that's
What I love about your research is that you did all the research December, January, and said, well, it's quite odd, but I think it was the fifth year this is the strongest year of the 10-year cycle. So if you choose a year that ends in 0, 1, 2, 3, or 5, fifth year's just outperformed. So quite often it's a very large gain for the year. So when the brokers are all saying, well, that they're looking for a 10% gain, that sort of fit. But look, there's still about another 8 months to go, and they could all be right with the very first prediction, couldn't they?
Yeah, so look, the one thing about the 50 years and the post-election years is the first quarter is the danger zone. We're seeing there just a lot of March and early April lows. If you go back and look at every 50 year and every post-election year, that's a common thing. So the first quarter is the danger quarter. So we're through that now. We're only just, so we're into the period there where we are in the sweet spot for the year now. So coming out of sort of, because even those sort of fifth years that had sort of mid-March lows, the market really didn't get going until April. So the post-election years and the 50 years really sort of the sweet spot was from April sort of onwards there. So, we are in sweet spot for the year here. So, sounds weird, but you sort of almost get invested here and close the eyes and open them in 3 months. I think we'll be a bit higher. Do that. You're doing personally, but if we could do that, I think you'll see the market will be quite a bit higher in 3 months from now.
And just to finish off, I'm going to give a book recommendation because the amount of times you've referenced this author's material in the last 12 or 18 months has been quite a lot. And it brings to mind when you're talking about not just gauging the numbers, the Fibonacci levels, but also the hysteria in the markets. I remember reading this book, and the author talked about it, and he actually had newspaper clippings from the 70s showing the headlines of bullish phase and bearish phase and bullish, and it was going in 3 and 6 month, 9 month cycles really quickly, rapidly up and down. And so if I can just get your thoughts and comments on, before we go, Stan Weinstein's book, Profiting in the Bull and Bear Markets, I think it is.
Yeah.
What are your thoughts on that book?
Yeah, that's a good book there. It's obviously more the sort of cycle there. So Stan's more of a sort of patient there. He'll wait for the market to be coming out of the stage 4, and then, so he won't be investing in stage 1. So if we have found the low here and we're bouncing, we're probably just about to commence, in theory, stage 1.
He's not there yet. Yeah.
He's not investing there until basically that we've seen some strength there and we stabilize, and then we start to break, start to break some higher highs. So, So I mean, it's a great book in terms of identifying there. I mean, it's like O'Neill, sort of like if you just use the 50-day moving average for your momentum stocks, if all the stocks broke below the 50 days and you got out of them, you probably would have saved a fortune. So if you're just a momentum trader and trade that, I mean, but just understanding things like that, just you're sort of seeing things there. But yes, I guess it's it's funny actually. I don't know if you probably can't see behind me there, but I have I've got a board there. This might be bad luck as well, but I've had this 1929, I think it's October 24th, October 29 newspaper that I've had in my possession about 10 years. I finally got it framed like about a month ago, but I picked it up a week ago. And so it's basically got, the headline is Wall Street in panic as stocks crash, and it's got articles on the crash. And I think that the same night the Royal Prince of Italy was an assassination attempt. This is really interesting sort of newspaper articles. In those days, everything's in the paper.
Yeah, that was the only medium.
Yeah. Anyway, but it's but since I got that home here and put it there, the stock market crashed. The market was pretty much down every day that I've had it. I was like, should I get rid of that thing? It's down every day I've brought it into the office. So, but hopefully it's over. Yeah, maybe I'll turn upside down or something. I don't know. Face it the other way for a while, but.
Well, we'll know in a little while about that omen. And thank you very much for the research. We'll come back the other side of Easter for an update on best trading shares, portfolio update, what to expect from cycles, and how do I digest what the market does in between now and then. Thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.